You did everything right. You maxed out your 401k, you paid off the mortgage, and you followed the standard advice to defer taxes until you're in a lower bracket. But then, you hit age 65, and the math stopped working. Suddenly, your Medicare premiums doubled. Your Social Security check, the one you paid into for 40 years, got slashed by taxes you didn't know existed. You aren't in a lower bracket. You're actually paying a higher marginal rate than you did when you were working full-time. This isn't a mistake. It's a specific, codified mechanic in the tax law. Financial planners whisper about it as the Tax Torpedo, but the IRS simply calls it the algorithm. And if you don't disarm it before you file for benefits, it'll confiscate up to 85% of your Social Security and spike your healthcare costs, regardless of how safe your portfolio looks. Welcome to Retire Rich. Today we're exposing the hidden retirement penalty that punishes you at age 65. So be sure to like this video and subscribe to stay ahead of the tax man. Here's the problem. You've been trained to look at the wrong number. Most people obsess over their withdrawal rate, the 4% rule. But the government doesn't care what you withdraw to spend. They care about what you're forced to show as income. And there's an invisible line in the sand where earning one single dollar over the limit doesn't just get taxed, it triggers a chain reaction. So, we need to talk about provisional income. This is the formula the government uses to decide if you are too rich to keep your full benefits. They take your adjusted gross income, add your tax-free interest, and then, here's the kicker, they add back half of your Social Security benefits. If that sum hits a specific threshold, the trap springs. For every additional dollar you pull from your IRA to pay for a vacation or a new car, you don't just pay tax on that dollar. That single dollar drags another 85 cents of your Social Security benefits into the taxable bucket. Think about the physics of that. You withdraw $1,000. You expect to pay, say, $220 in taxes. But because of this phantom calculation, your taxable income actually jumps by $1,850. Your effective marginal tax rate explodes. You could be in the 22% bracket on paper, but on that specific withdrawal, you are effectively paying over 40% to the government. And it gets worse. This phantom income creates a domino effect that hits your healthcare. It's called IRMAA, the Income-Related Monthly Adjustment Amount. It sounds boring, but it's actually a cliff. If your income is just $1 over the threshold, your Medicare Part B and Part D premiums skyrocket. It's not a sliding scale. It's a surcharge. You could literally pay thousands of dollars in extra premiums just because you sold a few stocks at the wrong time in December. Now, at this point you might be thinking, I'm not a multimillionaire, this doesn't apply to me. And that is exactly what the system relies on you thinking. This penalty doesn't punish the ultra-wealthy. They have tax shelters. And it doesn't touch the low-income bracket. They don't hit the thresholds. This is a laser-guided weapon aimed directly at the mass affluent, the diligent savers who built a nest egg between $500,000 and $2 million. If that's you, you're sitting in the blast radius. So, how do you defuse the torpedo? You have to stop thinking about tax deferral and start thinking about tax location. The traditional advice to defer is what built this bomb. By pushing all your money into traditional IRAs and 401ks, you created a massive pending tax bill that the government forces you to pay via required minimum distributions. The antidote is strategic tax bracket arbitrage. This means deliberately realizing income now, before age 65, to fill up your lower tax brackets. You essentially prepay the tax at a known low rate by converting traditional funds to Roth funds. You take the hit today, voluntarily. Why? Because Roth withdrawals do not count towards provisional income. They are invisible to the formula. They don't trigger the tax torpedo. They don't spike your Medicare premiums. If you strip the tax liability out of your accounts before the government forces you to take it, you regain control of your effective rate. The system is designed to funnel you into a high tax corridor just as you become most vulnerable. And the standard advice is just the conveyor belt that gets you there. You can accept the penalty as the cost of success, or you can restructure your assets to become invisible to the algorithm. But you can't do both.